Big Mike, before I introduce you, I want to ask you to tell us something that you believe about real estate that might surprise us.
I don't know if it's going to surprise anyone, but it's the good old Warren Buffett. Be greedy when others are fearful, be fearful when others are greedy. So today, the fear is high and the greed is low. And it's a time to be greedy and to appreciate the fact that the market is starting to recover. Some folks may believe the market is already in the recovery. I certainly believe so.
Welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I'm your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial. And today I have the privilege of talking with Big Mike. Mike Zlotnik with Tempo Funding. You have probably heard him on his own podcast, on many other podcasts in which he is a guest. He's an investor, a fund manager, an author, an educator, a podcast host. Mike has a depth of expert knowledge in the investment opportunities in real estate. He knows what's hot, what's cold, what things are trending right now, and we are going to get a glimpse of that today and learn from Mike's expertise. Mike, thank you so much for joining me. How are you doing today?
Jonathan, thank you very much for having me. I'm great and happy to be here.
I'm really looking forward to this conversation. You have a wealth of experience that we can all benefit from. So, before we get into your expertise, why don't we start out with you telling us a little bit about your background and how you got started in real estate?
Sure. So I live in Brooklyn, New York, with my wonderful wife, with four monkeys and a cat, meaning four kids and a real cat. And my kids are at this point. I don't have small kids, but some of them are already out of the house and married, etc. But um, so I'm a mathematician by education. I'm a chess master. Came to the country in '89 from the former Soviet Union many years ago. Um, I I'm a technologist by almost trade. I spent 15 years in technology world, from rank and file to directors and vice presidents in successful companies. That career, I really enjoyed it. But then I discovered passive real estate investing in 2000. Bought my first apartment in New York City, and continued to invest passively in real estate ever since 2009. I was tired, exhausted from the technology career. Again, nothing wrong with that business. It was perfect timing for me to go full time into real estate. So I switched overnight, literally, and started essentially running Tempo Funding from 2009. It was right after the bottom of 2008 2009 crisis, and that's how my journey to full time real estate investing started. And a passive investing has always been part of the game anyway. So that's kind of my journey to start. And over the years, we've done quite a bit of residential real estate, hard money loans, fix and flip loans. We involved into commercial real estate investing from 2017. Sort of discovered that being a lender is a great way to get a yield, but building wealth takes a little more than that. And long-term wealth is created over time in real estate. Typically, as an equity participant, you can do better than that on long-term basis if you select the right projects. Of course, market goes through cycles, and we've seen some of that volatility in the recent interest rate hikes and the market correcting, and now we've started the new brave new age of interest rate easing, and that certainly feels positive if you are a commercial investor.
Mike, you mentioned a couple things when talking about your background that I want to pry into a little bit. You talked about buying an apartment building in New York City, I think prior to 2000. Did you do much investing in New York City? You personally?
Not real estate. Yeah, just to be clear, I bought my first apartment, not the building. Yeah, I wish I bought the whole building.
Gotcha. Okay.
It was a little over my financial capability at the time. But the yeah, before that, that was my first apartment. So the way most people invest is when they buy their first home. That was my first apartment. I got married and we needed the new home and bought the first primary residence apartment. So
I
to start
see.
a family, that's how it started. I didn't start, well, most people start by buying their primary residence, maybe a house or an apartment. In the city, it's apartment. In anywhere else, typically a house.
Absolutely. Yep. I was going to say, wow, if you started buying apartment buildings in New York City in the 90s, things have probably gone okay for you. But yes, absolutely. Everyone has to start somewhere, and most people start with buying their primary residence. And then another interesting thing that you brought up was you started investing in real estate in 2009. And that's when you transitioned from tech to real
Full time.
estate.
Yeah, I went
So
active for 2009.
yeah, so you went full time active in real estate in 2009, and the real estate world in 2009 is completely crumbling. And so things must have been pretty bad in your tech job for you to say, you know what, real estate sounds pretty good right now.
Well, so the tech job, it was kind of the transition was I was done with my last gig, and I had almost 15-year career and a successful career and successful exits. So from my perspective, I had financial capability to do real estate full time in essence. Although, of course, when you switch, you have a great job, and then suddenly you have to eat what you kill, per se. But the time was interesting. It was a time of a lot of short sales, short sale flips, and that's the first part of our business was to fund short sale flips. Literally, this is what we did for 2009 through 11. We funded ABC flips when an investor would lock in the property on a short sale from a bank, and then the bank would approve. Typically, banks were very, very, I don't know how else to put it, but dumb. They were approving these short sales at a discount to the fair market value, even though the market was so fluid because the market corrected massively. So folks were buying them at a discount. Banks were approving those short sale transactions and then immediately flipping them for a profit. And they needed capital. We provided this capital. And after a while, the banks smartened up a little bit, started to provide some anti-flip restrictions. I don't know if you remember that whole business. So we started to fund 30-day holds, 90-day holds, 120-day holds. At the end of the day, these projects turned from 2-day flip into a 4 months mini rehab project where they could still flip it. So it's kind of evolved, and we basically evolved with times and continue to fund a lot of these hard money loans. This was the name of the game. You buy these properties so cheap, even paying hard money made a ton of sense because you, as the buyer of the asset, could do really well regardless of the hard money costs. So that's kind of the basics of those years.
So you certainly got into active or full-time real estate investing in an interesting time. And so I'm certainly, at the transition of another market cycle. And so that's why I'm particularly interested to get your insight into what you believe is happening today, right now. So why don't we transition into you telling us a little bit about what your work in real estate looks like today with Tempo Funding?
Sure. So I'm a big sort of a geek following the Fed monetary policy. I certainly love that. And sort of a scholar. And sometimes you're wrong, sometimes you're right. But the bottom line is if you really listen to Jay Powell, he's actually the opposite of, if you remember, Chairman Greenspan, the conundrum chairman. You couldn't understand what he said. You need a translation. With Jay Powell, he's a pretty simple spoken, easy to understand chairman, and he signaled it at this point very, very clearly. They've hiked the rates in response to high inflation. They kept it at a very, very high level for long. The policy is hugely restrictive, and they started to ease. As we've already seen, the bond market, especially 5-10 year Treasury yields are significantly lower. They're off the peak. So the Fed is now catching up, and their forward guidance is pretty clear. So what we're recording this in early October, but the September meeting was such that they cut 50 basis points and they signaled the entire path to normalized rates. So the reason I'm spending time on this is to explain sort of where the rates are going. Commercial real estate, heavily dependent on the cost of money. So the path, the base case scenario here is Fed will cut 2 more cuts November, December, 4 more in 25 and 2 more in 26. Total 8 cuts. They'll cut about 200 basis points from the current Fed funds rate of 5% after September cut, with a target rate of 2.9. Right. This is just a general forward guidance, but I've read some of his further commentary and saw him speak at another think tank event. And to make long story short, people have asked him the question: Will you do another 50s? Will he cut again 50 basis points? And the answer is, it depends on the data. So if we see unemployment getting worse, if things get worse, they'll cut faster. But the base case is where they're going. So they basically stated the current policy is highly restrictive. They got to take it down to 2.9% neutral rate, and they're going to proceed on the current path unless things get worse. So all that said gives me the confidence that we have at least a base case outlook on the Fed funds rate policy, and then related, obviously, all the other interest rates like SOFR, secure overnight funding rate, and all the indices. So we have a clear path, at least for 200 basis points from here down. Maybe it'll go faster. What does it mean? It means that investors will start coming out of the closet, start taking the cash from there, under the mattress. Sooner or later, demand will pick up. Before, it wasn't clear when they're going to cut, how much they're going to cut, what they're going to do on a forward basis. There was more uncertainty. Now we have a little bit more certainty. And the market critically needs certainty. That psychological improvement will likely provide more confidence to buyers and bargain hunters. And then the bid and ask will be easier to bridge that gap and for the deals to transact. So who's transacting today? The sellers are still sort of motivated, forced to sell sellers. And then the buyers are still bargain hunters at their core. However, we all know the good old saying, buy when the rates are high, refinance and sell when the rates are low. So the general theory is the market has already started the recovery. How much and how fast we're going to recover, only the time will tell. But directionally, I can feel confident that many of the assets today that are somewhat depressed valuations, over time, they'll get better. So that's kind of the big theory. And then next, I'll tell you what we're doing, how we're participating in these opportunities. But I wanted to lay out this theory first, because some folks are saying, well, we don't know, maybe inflation will respike and things will go haywire again. Yeah, a lot of things are possible. But at this point, COVID helicopter money is kind of gone. We're not getting another massive fiscal spending. And the supply chain is no longer broken. Yeah, there's some tensions with China. There's global possibilities of wars, etc. All this stuff is not necessarily news. But the U.S. inflation primary drivers are gone, or at least they're not. They're not to the degree where they used to be in the past. So we're likely on a more steady path. There's a significant risk of consumer being tapped, unemployment getting worse, and the Fed may actually accelerate. So what I'm seeing is, from commercial real estate perspective, it's almost golden time to participate. Of course, you still need great care and be careful. Don't just buy everything you see. But the overall picture is meaningfully improved at this point, and I feel we're acting with more confidence today.
Really interesting stuff. I'm a fellow geek like you are. I listen to this economics podcast, this daily economics podcast. And so I really try to stay up to date with what the Fed is thinking and doing and saying. And it's really interesting to follow if you're a fellow geek like us. But also, I think it's important to note that recovery is not linear. And that I think a lot of people in the real estate world believe, like you, that in general, commercial real estate has probably hit a trough sometime, over the summer, and things are improving now. But there's other factors like rents and absorption and supply coming online, and those things are going to certainly impact certainly the multifamily world, and also things like large industrial things like million square foot product. That's a lot of which has come online over the last couple of years. And so there are nuances, and recovery isn't linear. But in general, I think a lot of people are with you in the commercial real estate world that things are looking brighter, but that's not to say that there aren't going to be sponsors that are struggling. So having said all that, Mike, where are you finding opportunity? Where and how are you spending your time and energy these days?
Sure. So let me first comment on what you said on the new supply. And we've seen significant new supply in certain markets, in multifamily, some industrial, and other asset classes. Typically, these markets have been a little bit faster growth. Let's just call them Sunbelt regions. Have seen a lot more construction than some of the Midwest and other ones. And by the way, one of the simplest and easiest arguments why it took place is it was much more profitable to build in those markets. As the rents were higher and the prospects of growth were higher. So the new construction is all local. So there's of course, every market is different, and the recovery in one part of the country may be very different from another part of the country. So all investors should most definitely pay attention to the supply-demand balance and equilibrium. Although the new supply shock or the new assets, they were from the originations a few years ago. Well, now it's the reverse is true. So many of these markets are not seeing new developments because the rates are high. So almost the reverse happened. So something interesting happening. The projections of new supply are significantly dwindling for 26 and beyond. 25 is still going to have some deliveries. So all that said is we like actually Midwest. Even though there may be better buy opportunities in Sunbelt, you have to know what you're doing. You have to be very, very sort of vertically integrated in a given market and have great confidence that you're getting the right price in that market, and you're going to be able to manage oversupply for foreseeable future. So all that is a market specific. The reason we like Midwest, steady Eddie, a lot less product, a lot more predictability in rents. Volatility of rents is significantly lower. Volatility of valuations are lower. So today we are seeing still significant liquidity pressure on many projects that were bought, let's call it from the year 2020, 2021, 2022, when the rates were incredibly low in the post-COVID world. And many of these projects just didn't build enough capital reserves. Now, they might have still bought the right properties. They're still executing the right value add plan, but they're out of cash. And we've looked into a broad range of assets. And the key observation is about 3/4 of all liquidity needs are related to higher for longer rates, and the bank being unhappy or the need for additional capital to set aside interest reserves, tax and insurance escrows, even pay down some bank principal versus the additional money needed for construction. Some cost overruns, some inflation related. So we see 3/4, let's just call them financing related costs, and 1/4 related to other things. So this liquidity needs are pretty serious in some projects, and some other projects they're light. It depends on the type of project, of course. There are assets that justify additional capital injections, and there are assets that do not justify. The math just doesn't work. The value has fallen so much that you can't bring any new money to the project. You need the bank to take the asset. You need to get a discount from the bank, right? Or get some kind of a cooperative sale with the bank taking a haircut. Those extreme cases, again, we don't see too many of those. What we do see is pretty common, is where they are sort of, let's call them sufficiently equity rich, but cash poor. Why cash poor? Again, they borrow on floating rate debt, value add projects, the rate cap expired. Now the bank's requiring either new rate cap or set aside interest reserves. Even in some cases, we've seen pay us down a little bit on their primary balance. We'll give you some more runway to finish. So the capital is needed primarily to move these projects forward, to provide liquidity for the next, let's just call it 1.5 to 2 years, to be able to be well capitalized, well prepared to execute the business plan. And some of these projects have tried capital calls. So capital calls has been sort of a very, very painful conversation, and they rarely ever work. I've spoken to many guests on my podcast and other industry leaders. Most of them get about a third participation. Most investors just don't want to give them a check, don't like it. They are stressed, frustrated, unhappy. The bottom line is capital calls don't really work. And there's another reason why capital calls don't work, because they don't trust the manager, and you're going to give them the money in a position on a capital stack similar to your previously invested money. So it doesn't really work. Most investors just don't feel comfortable. What works in a much better way is fresh money. Let's just call it mezzanine debt or preferred equity ahead of previously raised equity, but between, let's just call it primary debt and current equity. And that whole approach essentially not guarantees, but from a structure perspective, gives new money priority over previous money. So again, it's not a capital call. It's either a member loan or a mezz debt or preferred equity. It comes in, pushes existing investors back. Do they like it? No. Do they have a choice? Well, you have a choice. You're out of money. You can turn the asset over to the bank, right? So most existing investors don't really have anything to say other than they want the capital to survive. So in order to survive, it needs liquidity. And the managers, most of the managers have the authority to encumber these projects with additional mezz debt, right? And they're doing it in the interest of investors. So the opportunity today, in my view, is essentially this mezz debt. Why? Because we basically get equity-like return without equity-like risk. That's the best way to describe it. Most of these loans we've been funding and underwriting, we're looking to charge 20% interest rate, get some points, in some cases even get an equity kicker. Now we're not counting for an equity kicker. If there's any value to that, that's wonderful. But getting a couple of points, 20% interest rate, and just to be clear, 20% not all current pay. Most of these projects can pay current pay 20%. So you work with a borrower, you have current pay of 11, current pay of 12, and then the rest is deferred. So it's something becomes a compromise. The other thing we've done is we've overcapitalized by actually requiring them to have interest reserves of 1.5 to 2 years, literally overfunding the mezz to the point where we have enough capital for all the operating needs plus another 1.5 or 2 years of interest reserves that we control to make sure we have paid our due interest for the next 1.5 to 2 years. Now it feels expensive to the owners, but on the other side, what do you do? What else? What other options do you have? You can't do capital call. Oh, you are an existing owner. You're more than welcome to participate in the mezz transaction. Not only you're welcome, it's actually the right thing to do. You're the most motivated party to participate. And the returns on the mezz, on the new money, are pretty strong. So we see that as a strong opportunity for fresh capital with the great sponsors on the great projects, typically in less volatile markets. The reason, again, Midwest is if you go to Houston, you go to Austin, you go to many of these markets, valuations corrected so much. It's so hard to find these type of deals that have enough equity cushion behind them. That's why the strategy is likely more applicable to certain markets where the values haven't corrected the way they corrected in the South. So from that perspective, these projects still have equity cushion. In some cases, we've seen full value add executed, where the property is virtually renovated, the rents are significantly higher, but they're still leasing up, they need a little more time, and there is pretty significant as is equity margin, where our mezz debt comes in behind primary debt, and we are at about 75% combined loan to value ratio. So that 75% CLTV and a 20% rate that I'm collecting on this type of deals feels pretty good to me as an investor. And current investors, my view to them is this is participate, ask the project sponsor, hey, can I participate in the mezz? And most of them will absolutely take your money. And if you can't participate, just know that without that money, you'd be much worse than with that money if the project completes its business plan. And also just the market timing. If you just basically think about this, where the interest rates will be. And I'm saying will be with the uncertainty and no guarantees factor. The Fed signaled we're going to get down in 2 years, a year and a half, by about 200 basis points. If that happens, we're going to see meaningfully better cap rates. So just the change in valuation related to the interest rate changes could pay for the cost of all this mezz debt at even that expensive money. Plus, if the project operator renovates, improves NOI, and you have another bump on that front, all of this justifies the exercise. Or you can do a fire sale today, even take a haircut, and becomes an option for investors to make a decision. You take the mezz debt, expensive mezz debt, you live for another year and a half, 2 years. Oh, at that point, you have a ton of refi options, you have a ton of sale option, or you basically try to sell today, and today it's still vultures. Most of the buyers are not going to give you the price you want.
Mike, you've laid out this idea of mezz debt and pref equity probably better than anyone that has that I've talked to. So thank you for taking the time to explain that. So you've gone through the details and kind of both sides of what the operators are feeling and how you see the opportunity of, and you've called it mezz debt, we've called it pref equity. I think I also hear it called rescue financing. And so these are operators with a good asset and a good business plan and good operations, but they just maybe made a bad decision with their original financing. And so you're coming in at a very high interest rate, but you've got operators that are stuck between a rock and a hard place. And you said it really nicely. What else are they going to do? You can give the keys back to the bank, or you can try to salvage the deal by paying this mezz debt. What I want to go into a little bit more is essentially, how do you ensure that you're not throwing good money after bad? So you get this sponsor and this deal, and this deal is underwater. It's not worth what they paid for it, and maybe some buildings need new roofs, parking lots, other capital expenses. They don't have money, and so you come along and say, "Hey, this is a great opportunity." Can you go into a little more detail about how you make sure that the deal you're investing in is salvageable and you're not just throwing good money after a bad deal?
Sure. So, number one, you have to focus on the operator. Who is the operator? So if you have a beaten up, collapsing, non-functional operator, that's a non-starter. So you got to start with a strong operator that basically got hit by the market, the tidal wave that hit the entire market. So these operators are usually vertically integrated, they're strong in certain markets, and they have abilities to execute their business plan. So you're starting with all the fundamentals. And then you try to understand why they haven't really executed. The banks haven't been funding the draws because the banks have been nervous. So construction is somewhat behind the plan because of slow bank funding. Okay. And the banks have been directing those extra funds to be paying, interest due on these loans, etc. You have to look at the fundamental value on the asset space. It's super hard, right? So if the asset was bought at a certain price, what is it worth now? If you use purely cap rate, it becomes difficult because you have not completed business plan. So you have to look at cost per door. You have to look at number of other factors. What would it take to build a similar property? So ultimately, you have to come to a decision what this property could be worth per door in the next couple of years when the business plan is executed. Of course, you use the cap rate approach as stabilized, and in parallel, you use the cost-based approach because we've seen real inflation. Building new assets cost a lot of money. So existing property, that's why it's called real estate, because it's real. There's an underlying value. So in your underwriting, you have to have the confidence that the deal is not upside down. In other words, primary debt is not greater than the value of the asset. There has to be a margin of safety. I'll just give you one example of a property we did in Indianapolis so you can actually see live example, not a complete theoretical discussion.
Great.
So we participate in the equity of a deal. It was bought in June 2000, right after COVID, at a phenomenal price by a great operator we've done a lot of work with. And to make the long story short, at this point, they've executed value add. It's a big asset, about 1,000 doors. They had it 96 doors. Apartment complex is called Riverbend Apartments in Indianapolis. And they're almost done with the property. They have now renovated heavily and they're leasing up. But the project is light on cash. It needs some liquidity to get it to the finish line. So the money senior to us is $117 million. We looked at the capital stack. We obviously knew the project because we invested in the equity of the project. $117 million, and the project needed $7 million mezz debt, roughly. So we're all in at 124. So we looked at the property on the as-is basis, and we came to a conclusion that a fire sale price would be 160, 165. I mean, literally, if they dump the property right now, that's what they would get. And then if they just waited, and the current appraisal is over 180. The problem is we have to discount that. The current appraisal, it's all estimated. So 160, 165, margin of safety on the as-is basis is about 75% LTV, CLTV. And then if you do as repaired value or as it's completed, as stabilized, you can get to 180, 185, whatever number you want to come up with. So on a project like this, it's fairly easy. It's $7 million behind 117. You wind up at a pretty conservative point of view. If the property was worth on the as-is basis like a 130, you can't do anything. You're done. The point is, this property, it's equity rich, cash poor type of environment. This was an easy kind of way to underwrite. So we looked at this. Obviously, we obtained personal guarantee from a sponsor, and the property at this point is relatively, I don't want to call it easy lift. You still need to lease up from 80 to 90% occupancy to 95. There's a lease up work. There's a lot of work involved, and it's a big property, right? So you have to execute. But that is sort of easier than renovating heavily and leasing up. So overall, we feel pretty good about that project. I'll give you some other examples that we've done. We've done projects that still need a lot of work. And similar situation, but your as-is value is meaningfully lower. You're not at 75% as-is LTV. You're still positive, but a smaller number. What do you do in that case? Well, you have to look at a few things. One, obviously, how strong is the sponsor? Can you get a PG? Is the PG worth anything? Second, can you get additional collateral? And additional collateral is not an easy conversation. But if the sponsor believes in what he's doing and he has additional collateral and you can get that, right? Then now with additional collateral, you can get to that right CLTV that the new money feels it's not good money after bad money. So you have to underwrite carefully. You have to underwrite completely independently, which is hard to do, especially if you are looking at the projects that you already have some investments in the past. Most of the stuff we've been doing today are the projects we're familiar with. We've seen these projects in actions. We've seen what's going on. We've come to the conclusion independently, which is not easy to do. But for new money, we feel incredibly safe writing those checks. No guarantees in life, but relatively speaking, mezz debt is coming in at a place with the right sponsor, the right execution. It feels pretty good. Now, what happens with previous invested money? That's a difficult conversation. We've had conversations with people who asking me, hey, I'm in the equity of this deal. Am I going to get my money back? And when? And the answer is, I don't know. There's three possible scenarios I like to give people. Scenario number one, you will lose all your equity. And if you ask me 100 more times, it's not going to get any better. What we're doing is we're giving the project the capital necessary to execute the business plan. Let the property come to the market a year and a half, 2 years from now. And if the market is good, you will get your principal back. So you have scenario one, you lose all your money. Scenario two, you get your money back. Scenario three, you actually double your money. It's possible. It's very possible you get a decent profit. So equity outcome, highly volatile. Mezz debt or pref equity, fresh money, you can achieve relatively good predictability of the outcome. No guarantees, there's still risk, but at least you have to look who you're investing with, what kind of project, how complex is the business plan from here, what could be additional risks, what else could go wrong? Can you overrun the costs again? How do you make sure that you actually have enough capital? And we've solved for that. When we budget a project called $7 million, we estimate, can we give the project another $1.5 million, right? And when you look at this and it's like, yes, you can do that. If you give it another $1.5 million, it's going to get there. So you buffer it. So if you buffer enough and the business plan is good, the operator is good, you have a pretty good chance that the new money is not, good money after bad.
You're laying this out better than I've heard anyone else lay this out. So I definitely appreciate that. The examples are really helpful. I want to ask you about returns for your investors. So it sounds like if you come in on the mezz side with tempo funding or with another group that does this, you are ahead of the previous limited partners on the capital stack. You get paid back before the limited partners that were there with the initial deal. So if you're charging 20% interest or thereabouts and sometimes get equity, what sort of returns do your investors expect?
So classic question and the classic answer. So the way investors participate in this, we have a new fund. Well, not new, it's been a few months. We launched it earlier part of the year called Tempo Advantage Fund LLC. Not promoting, but let folks just hear about what we're doing, and then they can request PPM to accredited investors only, consult with the attorney and CPA professional. This is not a sales pitch. It's just how we structure the fund.
I asked the
We
question.
put a mezz. It's a fund that is structured as an institutional product. We pay investors 8% preferred cumulative return. We have 2% management fee. When we charge points, we split 50-50 between investors and the fund. And then the proceeds over 8 pref are split 80-20. Institutional quality waterfall. Classic, called 2 and 8. 2% management fee, 20% promote after investors get full 8% pref. It's a very simple, high quality product. And that fund invests in a lot of these loans at 20%. So of the 20% with 11% current pay, we typically have enough to distribute full pref at 8, pay 2% asset management fee, and there's 1% left for expenses, for additional split. So, and the target return in the fund, just using really basic math, if we collect 20, we pay investors 8, we keep 2, and then the rest is split 80-20, we project to be over 16% total return to investors per year through this waterfall. And then the equity kicker is added bonus. If we can get some more money, some more, sort of icing on the cake, that's great.
And I think it's important to note, and maybe I'll just ask the question: how do you view risk? We've talked about risk a little bit already, but projected 16% returns in a fund like this is not equivalent to projected 16% returns on another deal. So, how do you view the risk profile of this style of investing?
Sure. So, if I compare and contrast to the equity returns, a lot of funds in the equity front projected returns, I don't know, let's call them mid to high teens, right? And if it's a one-off syndication, you can have even target return over 20%. It's possible that if you take equity participation today and you buy at the right price, we've participated, by the way, in some of these equity deals as is, with target returns in the mid-20s. It's possible to get equity when the right buy, the deep buy, the right discount, to get equity now to look like low to mid-20s. So, but it's equity risk. This is sort of secondary debt, mezz debt, preferred equity. Risk profile on this, in my view, is lower than participating in the common equity. Now, it's not primary debt, it's mezz debt, but investors should look at it this way. They obviously have to have confidence in the folks who underwrite these loans, us, our management team. And by the way, the fear is you can never write a check before you know, like, and trust somebody, right? No matter what. So they have to establish this know, like, and trust us as fund managers that we know what we're doing underwriting this type of loans. From a risk reward profile, on most of these deals, we secure these loans, as I mentioned, 3 different ways. One is we have security instrument on a property. Some cases we can record a lien, some cases we cannot. But we generally at least get minimum for sale provisions, number of other provisions that gives us sort of ability to enforce the loan. 2, we typically get personal guarantee from the borrower, and we do want to see a very capable borrower. Furthermore, as much as possible, we ask for additional collateral, cross collateral. This is a standard procedure in lending. If you can get it, if you don't feel the primary loan is sufficient. So essentially, you're looking at a loan where if you just participate in first lien loan with low risk, you could still get, in this environment, let's just call it 9-10%, or you can get a little bit more comfortable with mezz debt and the risk profile and the return target that's substantially higher. Nonetheless, it's not risk-free. So can something go catastrophically wrong? Of course it can. But we do see most of the deals that we've been underwriting with a very, very high confidence because we know these deals. The as-is value is already somewhat depressed. The execution strategy is straightforward. So the execution risk is manageable. Valuation risk, if you feel comfortable on an as-is basis, you don't need the values to go up much. We also look at the interest rate risk. The interest rate risk is massive tailwind now. We have nowhere to go but down, right? It just, you could still say, hey, the inflation can respike. Yes, if you are an inflation bug, is it going to happen in the next couple of years? Highly unlikely. Could we go back and see something in 3, 4, 5 years? Can we see the U.S. government printing obscene amount of money and causing more inflation? Yes, it's all possible. But in the 2 to 3 year time horizon, maybe even I would call it 5 year time horizon, I don't see inflation reaccelerating unless we see another black swan event. The government, just dumps a lot of money into people's hands. So if you eliminate some of these crazy risks that are black swan risks, at this point, interest rate risk is not a big risk. In fact, it's a significant opportunity to see meaningful improvements in the evaluations of these assets. So as a lender, I put out a couple of educational pieces with the following real basic statement. So interest rate cuts help both debt investors and equity investors. Most people don't understand. They think it helps equity. For sure, it helps equity because it increases cash flows on equity. It increases valuations, right? Very, very, very basics. But it also helps lenders significantly because it typically lowers LTV. So as rates fall, valuations gradually improve. You're going to see overall LTV improve. So as a lender, I feel pretty good from that perspective. I don't know if this is all the risks, but at least some of the big risks are addressed through this conversation to whatever degree people feel comfortable. I still want to be in equity. I still want to get my depreciation. I still want to participate in these deals where we can get a deep buy, but it's a very low transaction volume there. I hope it's going to get better. Genuinely great deals, because as much as possible, sellers are doing exactly this. They're doing capital calls. They're obtaining mezz financing not to sell the property in a fire sale. So the few that are forced to sell, yes, you may get into a deep buy, but at that point, how comfortable are you that it's really a deep buy? I am pretty comfortable being a lender at 75% CLTV at 20% interest rates versus being in an equity of a new deal that kind of feels like it's a deep buy, but I'm not yet comfortable there. So it becomes give and take. The other really interesting point I'll make, we've done another loan, but on a new construction project in the same space where it's not an existing asset, but they were a little short behind the bank debt. So in the new acquisition, we see kind of a little bit of that opportunity too, when they struggle to raise all the common equity and they can't quite do it fast enough, and they can't quite do it to the size that they need. They have bank financing with a much more conservative first lien loan, and we come in with a little bit of a gap. We've done a little bit of that too, as a bridge to let them raise equity over the next 9 months. So this opportunity exists both in existing and some possibly new projects too.
And passive investors in pref equity are paid back upon sale of the property?
Usually, yes. Well, you can get your yield. So if it has a current pay, you will get it current distributions. So whether it's pref equity or mezz debt, if there's a contractual obligation to pay current, then folks get paid current. The rest, of course, has to be on a capital event, which is typically refi or sale. Is refi idea come back and become viable again? I think so. As rates fall, there's going to be more and more opportunities for refi, but only the time will show. And ultimately, yes, it's a sale event, and you get back all your money back with all the accumulated underpayment of the pref, etc.
Well, I find the financing behind the real estate. I love real estate, but there's this other layer of the financing behind real estate. I find it fascinating. It's an area that I have a ton to learn, and you clearly have a ton of experience. And so I sincerely appreciate you sharing your experience and expertise with us today. If listeners want to connect with you and learn more about Tempo Funding, where would you like to send people?
Sure. So Big Mike, right? The name sticks. I'm called Big Mike. There's a reason. It's a cheesy name. So we have primary website, tempofunding.com, but it's a little harder to remember. The easier way to remember, Big Mike, and I'm a fund manager. So bigmikefund.com. You could land on a web page that is a little bit about Big Mike, but it's a cheesy name, but easy to remember. My podcast is called bigmikefund.com. And here comes the best part of the whole conversation. If you misspell it, if you forget the D at the end, you go to the bigmikefund.com. I promise it's not a kinky psych.
All right, Big Mike, I sincerely appreciate your time today. Thank you so much for being here.
Thank you, Jonathan. Thank you for having me.
Listeners, if you enjoyed this conversation, make sure you subscribe or follow wherever you're listening or watching this. We appreciate you listening. If you enjoyed it, connect with either one of us. We love talking about commercial real estate and the financing behind commercial real estate. So feel free to reach out to either one of us. We'd love to talk with you. Thank you so much for listening. We appreciate you. Until next time. All right. Thank you so much, Mike.
Thank you, Jonathan.